Greetings, tax tip lovers, and welcome to this week's Top Property Tax Tactics in just 5 minutes. Come gather around people to ponder how you might use a government-sponsored HMRC-approved structure to reduce your annual income tax bill by, in this case, £27,500. Inspired by a question I was asked following last week's video, I thought I'd tell you the story of Dan, who owns a number of buy-to-let residential properties in his own name. He's done well and has annual rental income of almost £100,000. Over the years, Dan's made some money and lost some money, backing others in their startup businesses as a deliberate strategy so he didn't have all his eggs in the property basket. Dan told us he doesn't give a toss about death taxes, and that's his right, of course. But income tax, Dan hates income tax with the same passionate dislike he told me he usually reserves exclusively for his third spouse. Over the years, Dan had asked several professional advisors to help him legally reduce his income tax bill. And frankly, I sensed he expected me to recycle the same old planning ideas he'd heard multiple times before. Dan's a philosopher, and he made an exasperated reference to Maslow's. I suppose it is tempting, if the only tool you have is a hammer, to treat every problem as if it were a nail. Well, Dan challenged us to think out of the zone, so we did, exactly as you're anticipating, or this 5-minute video ends right here. I delved into our digital filing cabinet under government-sponsored HMRC tax-approved structures, located our file marked Not for Everybody, which lives in the section called Plenty of Risks and Caveats, and there it was, the 1995 legislation, since amended, which was the basis for a simple solution. Well, nothing to hide here, so let's get on with how it works. You're welcome. Following consultation with his financial advisor, Dan invested £91,667 into venture capital trusts and received immediate income tax relief of 30% on his investment, i.e. £27,500. So Dan's income tax bill on his £100,000 of rental income for the year dropped from £27,500 to zero, meaning that he paid nothing. That's nada, nichts, zilch, that's zero in income tax, and all entirely within government and HMRC rules, regulations, and legislation. I've included the link to the official government guidance on VCTs above, just in case you want to check it out for yourself. And here's the thing. Maybe it was because Dan knew what he was doing. Maybe it was because his financial advisor knew what she was doing, or a combination of the two. But Dan's VCT investments did rather well, and he was hooked. Dan did the same thing for 5 consecutive years, each time with a range of VCT investments, as his aim was to keep claiming income tax relief indefinitely. And one of the conditions for income tax relief is that the VCT investment is held for 5 years in order to retain the upfront tax relief. So here's the icing on the gâteau. In year 6, Dan will sell his first VCT and reinvest the proceeds in another VCT. And assuming the rules remain the same, then there's nothing to stop him repeating the process every year using the same money. Which could mean Dan will legally pay zero income tax on his £100,000 rental property income indefinitely. Now, while I know that people who watch these videos are not stupid, the regulator's not convinced. So here's the regulatory bit. This video is designed to illustrate tax planning, which is legally possible under a government-endorsed venture capital trust scheme, which is approved by HMRC and which has been around since 1995. Well, the first VCT was in 1851, but that's the Victoria cricket team in Australia. There are risks, and plenty of them, and you need to understand all of those if you consider using this type of planning. Just maybe one of those risks is that the VCT investments actually do well as the country recovers from the ravages of COVID-19 and adjusts to Brexit. And Zoopla and Kazoo were both venture capital trusts. Disciples of Maslow's hammer might want to cover their ears now, because next week I'm going to tell you how you can legally reclaim tax paid in the previous tax year. Well, that was Dan's story, the choice Dan made, and it's not right for everyone. I'm not saying you should do it, but it might be an option to consider and which you might want to discuss with your usual advisor. And hey, if that conversation doesn't go well, then do get in touch. That said, there are other legal ways of achieving tax efficiency, and if it's time to take action to sort your property tax planning, then here's how. You can do nothing and stay in the exact same place and pay a shed load of tax unnecessarily, or you can follow the link above for a free power hour review with property tax experts who are ex PwC and ex HMRC, and will make your property tax planning like it was our own. All right. Stay bright. Catch you again for breakfast next week. Ta